Every boom ends with one question. When does easy money stop feeling easy? For years, investors lived in a world where returns felt effortless. Private credit became the darling of Wall Street, the quiet giant that promised high yields with low risk. You didn't have to time the market or guess the next tech stock. All you had to do was lend money to someone else and collect double-digit returns. It was a golden era, or at least it felt like one. The Federal Reserve kept rates low, liquidity was everywhere, and private lenders flooded the market with cash. Everyone looked like a genius. Hedge funds, pension funds, even small investors were convinced they'd found a secret path to steady income. But easy money always has a price. Because what feels effortless is rarely sustainable. Behind every boom is the belief that this time is different. That risk is gone, that growth can last forever. And that illusion, the illusion of easy money, is what we're beginning to see fade. As interest rates rise and capital tightens, the world of private credit is facing its first true test. The returns are shrinking, defaults are creeping higher, and the same investors who once couldn't get enough of this market are suddenly stepping back. But this isn't a story of collapse. It's a story of awakening, of realizing that wealth built on easy doesn't last, and discipline always outperforms comfort. You're watching Mindset for Wealth, where we decode global finance and explore the mindset that separates speculation from strategy. If you've ever wondered how markets really work, beyond the headlines and the hype, you're in the right place. Because the era of easy money may be ending, but the opportunity to learn, grow, and invest wisely is just beginning. So if you believe in thinking long-term, not just trading short-term noise, make sure to subscribe. And stay tuned, because in the next few minutes, we'll uncover what really happened to private credit, why it thrived, and what its fall can teach us about every financial cycle that ever existed. To understand why the era of easy money in private credit is ending, we have to remember how it began. The story starts in the ashes of the pandemic, when the world was flooded with cash. Central banks slashed interest rates to near zero, governments pumped trillions of dollars into the economy, and investors were desperate for yield. Bonds paid almost nothing, savings accounts earned less than inflation, and people with money needed somewhere to put it. That's when private credit became the golden child of modern finance. Unlike traditional bank loans, private credit allowed big funds and institutions to lend directly to companies, cutting out the middlemen. It was fast, flexible, and in a world drowning in liquidity, it looked like a win-win. A new breed of financial optimism emerged. Wall Street firms raised billions for private lending funds, promising returns of 10 to 12%, steady income backed by real businesses. The marketing was seductive: secured debt, senior loans, low volatility. The idea was simple and comforting. You weren't gambling on speculative tech stocks. You were lending to real companies, earning predictable returns, while others chased momentum. It felt rational. It felt safe. It felt smart. From 2020 to 2024, the market exploded. Private credit grew into a $2.1 trillion industry, outpacing private equity for the first time in decades. Investors poured in from all directions: pension funds seeking stability, wealthy families looking for yield, even sovereign wealth funds joining the game. Everyone wanted a piece of the action. It wasn't just greed, it was psychology. After years of volatility, investors were tired of surprises. They wanted control. And private credit offered the illusion of it. Locked contracts, fixed coupons, covenants on paper. It all looked disciplined and conservative until you realized how much optimism was baked into those assumptions. Because what made those double-digit returns possible wasn't superior skill. It was the era of cheap capital. When interest rates are near zero, money chases anything that promises more. And when too much money chases too few deals, standards quietly slip. Loans were underwritten faster. Risks were downplayed. Companies that would have struggled to get traditional bank financing suddenly found private lenders willing to sign big checks. It worked, until it didn't. The entire system was built on the belief that the cost of capital would stay low forever. But easy money always tempts complacency. It makes you believe that risk has been engineered out of the system, that you've finally found a way to earn high returns without volatility. For a few golden years, it worked perfectly. Fund managers boasted record profits. Investors felt safe and sophisticated. And headlines called private credit the new backbone of corporate finance. But beneath that confidence was fragility, because every easy return comes with hidden leverage, not just financial, but psychological. The more people believe the game can't end, the closer it gets to ending. And by late 2024, the music was starting to fade. The turning point didn't come with an explosion. It came quietly, in the way most financial shifts do. A few headlines here, a few comments from the Federal Reserve there, and then a subtle change in tone across Wall Street conference rooms. When the Fed began its series of rate hikes in late 2023, it wasn't the immediate pain that scared investors. It was the realization that the old playbook no longer worked. The foundation of the private credit boom, cheap, predictable money, had vanished. Suddenly, the math that once looked bulletproof started to break down. For years, private lenders operated in a perfect environment. They could borrow at 3%, lend at 10%, and call it skill. But when short-term rates climbed toward 5%, that spread, their oxygen, began to shrink. Every deal became harder to justify. Every borrower became a little riskier. At first, fund managers called it a healthy normalization. They reassured investors that their portfolios were diversified, their loans well collateralized. But beneath that calm, cracks were forming. Borrowers began to miss payments. Refinancing got tougher. The once endless flow of cheap credit turned into a slow trickle. You could feel the change in tone at investor meetings. The confident talk of untapped opportunity turned into careful discussions about risk management. That's how cycles always shift, not with panic, but with subtle discomfort. By mid-2024, big names like Blackstone, Apollo, and Ares were hinting at caution. Their quarterly calls stopped celebrating growth and started emphasizing discipline. They began tightening lending standards, pulling back from riskier sectors like tech startups and leveraged buyouts. It wasn't a coincidence. When easy money disappears, discipline returns. Not because people become wiser, but because they have no choice. For many investors, it was the first time in years they had to confront the question, what is my real risk? Private credit had always sold itself as secured. But security is only as strong as the borrower's cash flow. And when higher rates hit corporate profits, those cash flows dried up fast. Suddenly, the illusion of control began to fade. The beauty of private credit, its flexibility, its bespoke nature, turned into its weakness. Unlike public markets, there was no easy way to sell or exit. You couldn't just click a button and liquidate your position. You were locked in. That's when fear quietly crept in. Not panic, fear. The kind that comes from realizing the rules have changed and no one sent a memo. But this moment wasn't just about numbers. It was about psychology. For a decade, investors had been rewarded for optimism. Now, caution was the new currency. The smartest players weren't the ones chasing new deals. They were the ones sitting on cash, waiting for opportunities others would soon be forced to sell. The irony of every boom is that discipline always looks foolish at the top and brilliant at the bottom. By late 2024, stories of delayed repayments and restructuring deals filled financial pages. Nothing catastrophic, just a slow tightening of credit conditions. But those subtle changes matter. Because in finance, shifts happen gradually, then suddenly. The private credit industry was learning that lesson in real time. It wasn't the end of the world. It was the end of a mindset. The belief that capital was infinite and risk could be managed away. And as the era of easy money faded, a new question began to echo across boardrooms and trading floors. If high returns were just a byproduct of cheap money, what happens now that money isn't cheap anymore? The answer, as always, would separate those who understood cycles from those who mistook luck for genius. Every boom carries a story people want to believe. In the world of private credit, that story was simple. Risk had evolved. We had built systems so sophisticated, so data-driven, that old financial mistakes couldn't possibly repeat. Investors loved that narrative. It felt modern, scientific, and comforting, a perfect fit for an age obsessed with optimization. Private credit managers spoke about superior underwriting models, dynamic risk control, and portfolio stress testing. The language sounded reassuringly technical, as if complexity itself were a form of safety. But history has a way of humbling finance. The further you move from the memory of pain, the more comfortable you become with risk. After the 2008 crisis, it took barely a decade for the lessons to fade. Once again, investors convinced themselves that this time was different, that smarter models and stronger regulation had rewritten the rules of money. The truth was less impressive. What made private credit thrive wasn't innovation. It was complacency disguised as sophistication. The industry's success relied on the same fragile assumptions that fuel every bubble: that borrowers will always repay, that interest rates will stay manageable, and that liquidity will always be available when you need it. For a while, those assumptions held. The economy was stable, capital was cheap, and defaults were low. That's the dangerous part. When everything seems fine, risk doesn't disappear. It just hides. The illusion of safety through structure became the new religion of Wall Street. But in the end, leverage is leverage, whether it sits on a balance sheet or in the collective confidence of investors. The more private credit grew, the less private it became. Big asset managers packaged and sold their loans, creating secondary markets that looked a lot like the mortgage-backed securities of the mid-2000s. Investors chasing yield bought slices of debt they didn't fully understand, trusting that diversification would save them. It always does, until it doesn't. When rates rose and borrowers stumbled, the mask slipped. Suddenly, the low-risk portfolios revealed their true nature: a web of illiquid loans, opaque valuations, and interconnected bets built on optimism. The reality behind the boom wasn't innovation. It was leverage wrapped in complexity and sold as stability. That's how financial history tends to rhyme. People forget that the biggest risks are rarely new. They're just old lessons repackaged with new vocabulary. And when investors finally realize that, the illusion ends. When the illusion faded, the reckoning was quiet. There were no dramatic crashes, no headlines screaming collapse, just a slow realization spreading through boardrooms and balance sheets. The era of easy money had simply expired. Private credit didn't vanish overnight. It evolved. Funds began cutting back on risky loans, demanding tighter covenants, and focusing on borrowers with stronger cash flow. The euphoric fundraising that once defined the market cooled to a cautious hum. Capital was no longer abundant, it was selective. For small and mid-sized businesses, that shift felt painful. Access to financing became harder. Deals that would have been approved in a day now faced weeks of scrutiny. Growth slowed, and with it, the illusion of infinite liquidity finally broke. But in that slowing came something valuable: perspective. Markets don't mature in times of ease. They mature in times of restraint. The end of easy money forced investors to ask the questions they should have been asking all along. What am I really lending against? What's my margin of safety? What's my exit if things go wrong? Across Wall Street, a quiet humility began to take hold. Even the titans of private credit, Blackstone, Apollo, Ares, started emphasizing quality over quantity, patience over speed. The race for returns gave way to the search for resilience. For long-term investors, this wasn't a crisis. It was an education, a reminder that markets aren't machines. They're reflections of human behavior, of confidence, fear, greed, and discipline. The age of easy returns may be ending, but that doesn't mean opportunity is gone. It just means the rules have changed. The rewards will now go to those who understand risk, not those who deny it. Because the truth is, easy money teaches you nothing. But hard money, disciplined money, that teaches you everything. And that's where the next chapter begins. The illusion of easy money has finally faded. But what's left behind isn't emptiness, it's clarity. For more than a decade, investors believed they could engineer risk out of existence. They built models, algorithms, and spreadsheets that turned uncertainty into numbers. But no formula can change the truth that finance has always been, and will always be, a story about human behavior. Easy money made us forget that. It made us think success was skill when it was really circumstance. It rewarded confidence over caution and speed over patience. But cycles always bring us back to the same lesson. Wealth that lasts is never built on convenience. It's built on discipline. That's the real story behind the end of the private credit boom. Not the fall of a market, but the return of reality. Investors who relied on cheap money will struggle. Those who relied on judgment will adapt. Because real wealth isn't about timing the market, it's about surviving it. There's something powerful in that idea. When the world stops rewarding shortcuts, it starts rewarding understanding. The investors who thrive in the next decade won't be the ones who chase trends. They'll be the ones who master patience, clarity, and emotional balance. If this cycle taught us anything, it's that the easiest money often comes before the hardest lessons. But it's the hard lessons that build lasting wealth. So, as we move into a new phase of global finance, one shaped by higher rates, tighter credit, and real accountability, remember, the end of easy money isn't the end of opportunity. It's the beginning of wisdom. You've been watching Mindset for Wealth, where we decode the patterns of money, behavior, and global markets, helping you think like an investor, not a spectator. If this video gave you a clearer way to see the world of finance, give it a like, share it with someone who's chasing yield without seeing risk, and subscribe to Mindset for Wealth for deeper, data-driven stories that inspire smarter decisions. Because the markets may change, but your mindset is what builds wealth that lasts.